My name is Justin Scott from 876 Invest, and we're here to you today with a very special episode of The Vault. I'm joined here today by my colleague,
John Anthony Thomas.
That's right, and the ever-calculated, ever-working Khary Robinson. He is the founder of Norbrook Equity Partners and the executive chairman of Mailpac. And we're just going to have a great discussion with you and just let you guys get to know everything about him, about how he thinks, about how he gets to business, and where we're going from here. All right, Khary, how are you doing today?
Awesome. Thanks for having me, guys.
All right, perfect. All right, so the first question I want to ask is to just try and get a little bit more about your background, right? I understand you're a champion old boy.
I am a champion old boy.
That's right. Them say ready strong, man, but that's another thing. Anyway, right. But and further from that, I understand you finished university out in the States, right? How was that?
Finished actually high school in the States. So I went to Campion up to fifth form. My dad was spent time from my brother's years coaching Campion and helping a lot of the kids to get to school abroad. And so he got the exposure of seeing what it was and what the difference was for Jamaicans to get educated abroad, and not just the education caliber, but just the exposure of being in that environment. And so I think he was keen on giving me that opportunity. And so after fifth form, I went off to Choate Rosemary Hall, where I got a football scholarship. Choate is a prep school up in Connecticut. And then from there, I went on to Georgetown. So that's a good experience. Good experience in the US, great education. But Georgetown has a business program, and I studied finance. And so a lot of the investment banks came to recruit directly from Georgetown, and as well as a number of other schools. And so that created that path for me to get into Wall Street early as an analyst, and then that started the train that I think I'm on today, or at least one part of the train that I'm on today.
Yeah, that's amazing, man.
Wow.
All right. Like literally. So you actually get scouted by one of the leading brokerages on Wall Street, man. That's crazy, man.
Yeah, it was interesting times because I knew that investment banking give you a broad exposure to finance. But I didn't know the impact it would have for me long term. I grew up in a very entrepreneurial family. My father was an entrepreneur, my brother was an entrepreneur. We would sit at the dining table, many breakfasts and dinners, just thinking about ideas and opportunities and gaps in the market. And so I developed that entrepreneurial gene from a very young age. But what a lot of entrepreneurial instincts don't provide is analytical skill set to support that.
Exactly.
And so that's what I got in the financial world. So when I went into investment banking, I got exposure to a more structured approach to business, a more structured approach to thought around growth and financing and capitalization and so on. So that was, a great balance of entrepreneurship in house and then, finance as it from the outside.
Yeah. And which year was this when you actually started in Golan?
So I did a couple stints. I did my first stint actually at Bank of America Securities, which was the investment banking arm of Bank of America. That was 2001 to 2004. Then I came to Jamaica to start a company, ended up starting 3 companies there. But starting a company and running it from scratch, what I realized that the effort it took to get from 0 to 1 was the same effort to get from 1 to 100, right? Because you're working without resources. You don't have any support at all. And so I knew that, if I was to scale my entrepreneurial endeavors, I wanted to start not at 0, like I had when I just came back from being an analyst, but try and acquire a business and then grow those businesses organically in an entrepreneurial way, but also through acquisition. And so I decided to go back to business school, and that's when I went to Wharton in 2005 to 2007, and then went to Goldman. Actually went to Goldman in that summer, then thereafter, and then switched to Citi's PE group, and then got the opportunity to start Norbrook, and that's been the story ever since.
Oh, that's crazy, man. So that goes like right before the whole financial crisis and everything.
I tell people all the time. So when I was in my last stint, the largest LBO or private equity transaction was done in either 84 or 86. It's a story behind Barbarians and the Gate. It was the acquisition with KKR buying RJR Nabisco.
Yeah.
In 2007, my group alone did 6 transactions larger than that. And it was just a crazy time because, those are the days of the ultimate free money. There were these structured finance products that just gave us access to capital, unlimited capital at very, very cheap rates. And so, you had the HCA transaction, for example, which was $34 billion and only $1.5 billion of equity. So
okay.
it was interesting times. But, it became less about organic growth initiatives and more about financial engineering. And if you have that entrepreneurial gene, those two clash with each other because you want to find ways to really make a business sustainable and grow, not by using fake money and maneuvering the balance sheet, but actually by doing things to grow revenues and reduce cost. And so I knew that, that was a good opportunity and time to possibly leverage, some of that capital that was in the market to go and buy some businesses and actually grow them and run them properly. So I got the opportunity to buy Hertz car rental. That was 2008. I left my role, that's a story in itself, and spent 7 months working on due diligence and legal documentation and everything to buy Hertz. And 7 months into the process, we finished, had documents ready to sign, went to the seller's home to, finalize everything and had a couple of drinks, and then halfway through the drinks, he said, I don't think I'm going to sell again. And so that was the beginning and the end of my original vision for Norbrook. Because we had a couple of investors that had come to support us from the US. And after that, there was, their view was Jamaica is clearly a cowboy state where, you can be going down a signed agreement with someone and then, they change their mind at the very last minute. And so I had left the job, I had moved to Jamaica, and I didn't have Hertz, and I had lost my investors. But I really believed in the model. I really believed in the model that, Jamaica had good businesses, well-positioned businesses that just needed some young thought, some innovative ideas to grow. And so, with very little support, I went on the hunt. We hired, I hired one person at the time, so it was just 2 of us. And we went and just talked to entrepreneurs, and we got the opportunity to buy a smaller car rental called Compact Car Rental. Was run by Mad Siaga. And while, starting to run that business, because I was living in the US, I kept having to going to Mailpac because, I wanted all the things I used to get in the US. Yeah. And one day something said, why don't you just go upstairs and see if you can talk to the owners? And I begged to go upstairs and they let me up. I met Andrew Phillips, who was the owner at the time. He was, I would say, in his mid-40s. So when I saw him, I said, obviously, mid-40s, e-commerce business, these guys are not selling. But for personal reasons, and Andrew and Colleen, they were a husband and wife team, were great parents, devoted parents, and they had 2 kids that were about that age of going off to school, and they wanted to be more involved. And I think I just, caught them at the right time, and they said, you know what, we're thinking about, spending time with the kids. They're about to go off to school, and they decided to sell, and that was our second business, and that was the beginning of the novel story. We've owned that business. We've done 37 transactions since. We've built some businesses in the US, a couple of platforms in the US. We've built a couple of platforms in Ghana and West Africa. Mm-hmm. But our home is the Caribbean, and that's what we continue to do today.
That's amazing, man. Trust me, that's straight up amazing. Right, hold on. Sean, you want to go first?
I want to tack into something that you brought up a while ago.
Mm-hmm.
So you said earlier when you were doing Hertz, you had to go through the whole entire due diligence process and that kind of thing, and working overseas as well, and being exposed to that kind of level of information and those kind of things, and now buying companies in Jamaica and doing that kind of investment. What's the difference like with information and that due diligence process? Because I can't imagine that it's anywhere close to the same thing.
No, it isn't. Especially in the space that we play in, right? So we in those days we were buying companies that did between $200,000 to $1 million of EBITDA. Today, I think we buy business anywhere between $1 and $5 million of EBITDA. But when you get into that space, you're playing with true family-run, businesses, right? That hardly have any corporate governance, don't really have the best financial reporting. You can forget about things like audits typically. A lot of the family's personal life runs through the numbers. And so what we've developed over time through successes and failures is a methodology of diligencing, not in an atypical way, right? So when I was in the US and we were diligencing the business, all the information was there, and it was documented. We have to use anecdotal diligence, operational diligence, managerial diligence, customer diligence, get all of these touch points and factors to frame an idea around where this business really is and where this business really can go. But more importantly for us, we structure our transactions to appreciate for the risk that is embedded in a company that doesn't have clear information. So a lot of times we will use, I'm not going to go into the detail of it because some of it is our competitive advantage,
Right.
structures that allow us to manage downside risk in the future. Just in case the information we got was so bad that we miscalculated something, and that has helped us a lot. But the second thing those structures do is that it ties the seller in for some transition period and support. And so traditionally you'll see where a seller is participating with us for some time period after the transaction, which makes them less inclined to give you false information and misleading information, and also to help the transition and knowledge transfer when you take over these businesses.
Okay.
But definitely completely different environment from what I would have seen in the US.
How is it that they came up with that kind of stuff then, conceptually? Like when you buck up on frustration and you're like, where's all the information? How is it that you then decide, okay, so now this level of information from all of these other touch points, as you say, what now makes that an acceptable level of risk? Of course, you said there's other tools in your pricing and proprietary information and stuff, but like mentally, how do you kind of come to that kind of decision?
Yeah. So as I said, the benefit I had is having come from an entrepreneurial family and had been an entrepreneur myself. So when I left in Wall Street the first time, I started a BPO in Jamaica, and from scratch doing transcripts for a couple of companies in Canada, and then built a company called Jamflix, which was Netflix of Jamaica at the time. But you guys probably too young to know that there was a time when Netflix actually didn't have streaming. You had to, they would deliver 3 DVDs to you, and you would send it back and get 3 more.
It was nothing like Blockbuster was king.
Correct. And they killed Blockbuster. And then I also started a company called Tropical Phones, which allowed people traveling to the US to get a prepaid phone that they could use in the US. So they would, prepay for a certain amount of talk time credit and use it abroad because roaming didn't exist back then. And so having run and lived in a family that also run entrepreneurial businesses, it wasn't scary for me to see lack of information, lack of corporate governance, lack of documentation. But having seen the formal side, I could then find the marriage and say, okay, how do I get this, this high information up to a scale where I can feel comfortable doing a transaction and moving forward with that business. And we didn't always get it right. I sit here today probably because we got more right than wrong. But definitely there were transactions where I look back and I say, I don't know how, that one got the better of us. But there's been a few.
Yeah, because you have to learn like why things went right and why things went wrong, and then you have to learn from all of that and just keep altering the recipe from there.
Yeah.
Yeah.
So one of the things we are big on is codifying our successes and our failures. But where Norbrook stands today is that we really support entrepreneurs. And so all of our businesses are operated by CEOs, and we actively support those CEOs. But there's so much learning from having different businesses and having acquired businesses and so on, that we codify that and support these entrepreneurs, because they work within the company, but they're very entrepreneurial, to help them to not make the mistakes that we would have made in the early days.
Okay. All right. And speaking of that, I want to ask, all right, so the school of thought is that there are typically three types of private equity, right? You have venture capitalism, when you're basically taking a startup and you're building it up from there. You're putting in the seed capital to help advance it. You have growth equity, where it's a more mature company, right? Somewhere a bit further along their life cycle. Probably people know the brands at this point. It has a wide user base, whatever. And then you have buyouts, where you either buying it out from like your available assets or whatever, or some sort of equity deal, or you actually go into borrowing the money for it. Which would you say that you prefer and why, in your experience?
So one thing just to establish is that we are not a private equity firm, and not because we didn't want to be, but because there wasn't an opportunity to be a private equity firm. So the traditional private equity firm gets money from external investors, and then invest that money in a number of assets. And those assets can have an asset class. It can be a REIT, right, which is a private equity firm for real estate. It can be VC. It can be, as you say, growth equity. It can be LBO or buyout fund. And that's just the type of assets that they acquire. But it's all about taking money, injected it into good assets, and unlocking that value. When I moved back to Jamaica in 2008, as I said, I had lost investors, so there was no outside equity to come in, and there was no exit market. There was no capital markets. Today we talk about junior market and stock market. None of that existed. There was no private equity, so it's not like in the US, private equity firms buy a business, build it, and sell it to a bigger private equity firm. That didn't exist, and there was no strategic M&A. So even if I built a business in bully beef, it's not like Grace, I could build it up and sell it to Grace. The strategic M&A wasn't significant. And so my model had to be to try and find a way to get inside a business at a very low cost, because I had no external capital, and then grow the hell out of that business to try and generate capital, to try and generate cash, and then use that cash to go and buy another business. You have two streams of cash, and use that two streams of cash. And we kept doing that. And so that's why we would start with small deals in the beginning, and then we could afford to do bigger and bigger deals over time. But over time, I would say that buyouts are our specialty. And it goes back to what I said about why I went back to business school. Every business, I believe, takes the same amount of effort to run and to grow. Whether it is an ice cream shop, or it is, Mailpac. And so if you have the opportunity to scale, and you only have 24 hours in the day, then my preference or my decision has always been, let us go for more established businesses that have the resources for us to scale. But secondly, if you look at the tales of risk and reward, VC has a higher risk and reward range, right? So many startup companies fail, and then the ones that don't fail do extremely well, because they would have broken into a new market or created a new technology or whatever it is. And then as you come down the ladder, you're when you're back doing a buyout, you probably don't have this huge upside as a VC or a growth company or a tech company. But your downside risk is protected. The unique thing about emerging markets is that you can actually buy an established business like a buyout, and you still have the upside because it's an emerging market, because there's tons of inefficiency in the market, that you can use that platform to grow and go into other sectors and use technology to make it better. And so for us, we found over time that we got to be VC-like by using the buyout methodology.
In emerging markets, yeah, man. I check so.
Very much harder in the US because the US has a ton of capital, a ton of smart people, a ton of technology, a ton of, and so inefficiencies are lower. And we believe that value comes from inefficiency. If a market is completely efficient, you can't create value because everything that needs to be done is done. So what service or product can you provide if it's already there? In emerging markets, there's a huge opportunity because there's a big gap in inefficiency. You go to the tax office, you go to, a store in Jamaica, you go to, where it is, you're just like, it's so inefficient. But that means opportunity. That means that there's something you can do to make people's lives better. And if you can make their lives better with a product or a service, it means that you can create value from it.
Exactly. Once it's solving a problem, you've already found a business idea.
Correct.
But on that point, then, re-emerging markets and the potential upside that continues to exist, was it always your intention when you were going overseas, given that you're entrepreneurial and you know that you always had this drive? Was it always the intention to have a business in Jamaica or in the region then?
I'll tell you, I don't think I became intentional about anything until after business school. But if I was to sit here and tell you that I know what I can do 5 years from now, I'd be lying. What I will say is that I'm intentional about unlocking value through opportunity. So if the world tomorrow shifted and there was an opportunity that Jamaicans should go to space and there's a way to create value from that, I would tell you that's stupid and crazy. But 5 years from now, I'm going to tell you that, hey, I love this idea and let's go to space. So going to the US was more about exposure, just seeing more, learning more, being exposed to more, building broader relationships. I still, until COVID, I would still go to New York every Christmas and walk the streets for like 2 days just to re-engage with the ultimate first world environment, right? What are restaurants doing? What are retail stores doing? What's advertising doing? What's finance doing? And just have dinner or lunch with friends that I used to go to school with, and just absorb what an efficient market is, what is the stage that they're at, what is happening there, and then how I can use that to create value in an emerging market.
Okay. And so with that in mind, then, like, how do you identify which companies that you want to invest into in Norbrook's portfolio?
Yeah. If you look at our portfolio, you think that I just put a finger in the wind. But the reality is that what we look on is industry trends first, right? So which industry is going to grow? Because if you're a player in an industry that grows, you've already gotten 50% of the value. And then the second is, how do we then create a platform where we can be number one or two in that industry? And so almost in all of our industry that we play in, we buy a platform business, a company that is already operating, has resources and operating efficiently. And then we go into that business to understand the business and to refine that platform. Once we've done that, then we look to grow that business organically as well as through acquisitions. So you'll see, in the logistics space, we did, I think, 5 or 6 acquisitions to build Airpac before we did the deal with Tara. With our FedEx business in the US, we did 7 acquisitions there. Our commercial landscaping business in the US, we did 3 acquisitions there. Mailpac is made up of 3 acquisitions and a couple of startups. So it's always about, let's get into that space. We know that space is growing, health and wellness or e-commerce or consumer products. I see Justin asked a couple of questions about water. But these are spaces that we believe will continue to grow. The need will continue to grow. And then we just find a platform and cement ourselves and then grow within that platform through organic initiatives and acquisitional growth.
Okay. Do you find that there are any synergies between them? Like, you're working within one business, and then you find that information or the value that you're getting there can then be like transferred over, or you can add to that in another one of the businesses.
Yeah. So that's one of the learning lessons. We've been doing this about 13 years. And one of the learning lessons was how to leverage that, multi-company portfolio. And so there was a point at which we said, all right, we're going to have a central office that runs all the businesses. And that failed. And that failed not because central services doesn't work, but because each business needed its own unique culture for that industry. The type of culture to run a chain of gyms is very different than the type of culture to run a prepaid MasterCard business. But what we did find is that 80% of the characteristics of success within these businesses were the same no matter what the business is. The way you approach reporting and governance, the way you approach analytics, the way you approach customer service, the way you approach logistics efficiency. There are a number of things that you could learn from the different businesses and make sure that you have best-in-class processes across the board. So do we cross-pollinate our businesses? Not anymore. They're all independent businesses that run very independently with their own culture and style and whatever. But do we leverage the knowledge and the core skill sets of what we could call a Norbrook business across all the businesses? Yes. And that continues to be refined day by day.
Okay, I love that.
So, question. So how do you think about exits then, given that you're looking for those kind of characteristics? And so obviously, as you said earlier, sometimes there can be misinformation, made a bad judgment call, something went wrong in the execution or something, maybe landscape changes. But how do you think about exiting, and in both ways, negative and even positive, of like listing Mailpac, where you get a benefit out of it,
Mm-hmm. So the key for us about exits is that we don't think about exits. None of our businesses are built for exit. We don't go into a business thinking that we're going to exit. And if we exit a business, it's usually because of a strategic reason, not because of a financial reason. As I said, we're not a private equity firm, and so we don't have this timeline. Hey, you need to give back the investors their money in 10 years or whatever it is. We have the benefit of holding our businesses forever if we want to, and the truth is that's what we would hope for. So exits for us come when there's a strategic reason, when there is some value proposition in exiting. Now, people say, "Oh, you exited Mailpac." We still own 75% of Mailpac, so that definitely is not an exit. And the 25% shareholders are very clear that they want to get the maximum value, and we are responsible for that. So it definitely doesn't feel like an exit. In fact, it feels more of an entry than before, because now we have an audience that is caring about what we do. But the key to that, and you asked a question about if we look at the stock price and so on. If I'm to be very honest, yes, sometimes we look at where the stock is, or what this quarter earnings looks like or whatever. But the reality is that because we don't care about exit, and because we're not looking to exit, we're looking to build long-term value. And that, I think, creates better businesses, because sometimes you have to make tough decisions today to unlock value tomorrow. So I'll give you an example. In the last year and a half, we saw significant growth in the e-commerce space. And we said we need to be ahead of the game. And so we need to invest in the infrastructure of this business to make sure that if the business continues to grow, we're not scrambling all the time to say, how do we serve this market, or how do we process this many packages or whatever, which happened to us, right? When 2020 hit us, we weren't ready for all of those packages. And so we overbuilt our capacity. But that shows in our numbers. We just reported in 2021, we did $447 million in profit. And this year we did 400. And of course, we in our prospectus, we are where we said we were going to be in 2027. I'm thinking that's a great thing, right? But I see, there's commentary, your profitability is down. But that's for today, because we've invested in more stores, more drivers, more processing capability, so that 2 years from now, our fixed costs stay the same. We can take on all the growth of that volume, not be scrambling to serve our customers, and ensure that we create a sustainable platform. And so that's the beauty of not caring about assets. Not caring about exits. Definitely we care about assets. Not caring about exits is that we are building long-term businesses.
Right. Yeah, man. I definitely saw how you're building out the infrastructure, like with the lockers, right? So that takes out a whole lot of the stress from out of your hand, from the stores, from the drivers, right? So why have it all here, and then we're worried about all this when we can have strategic lockers placed in in good places and then people pick them up themselves, right?
Yep. And we're in a service business, right? At the end of the day, I think Mailpac is in the most competitive space I can think of in the market.
Competition to kill.
Yes, every day somebody wakes up and says, "Let me start," a Mailpac. And so, what is most important for us is service. To make sure that you as a customer get the experience, the most seamless experience that you can and deserve as an online shopper. And there's nobody more fanatical about that than Jeff Bezos and his team, right? They spend money. We don't have the luxury of doing this, but they lost money hand over foot for 20 years because they knew what the consumer ultimately would want, what would serve that consumer best, and what it would cost to get there. And 20 years later, we know where Amazon is today. And I live in the US, and I can order something and maybe by tonight it reach. And I'm seeing that evolution in Jamaica. Right? I'm seeing where we have reporting that shows us what comes. And it used to be car parts and house fixtures and things that somebody said, "Boy, I can't get this in Jamaica, and it's important, but I mean, wait." No, we see a little T-shirt, some 2 bar of soap, some gel. People just, they say, I feel comfortable with this process now. And so whatever I need, I'm just going to go on my phone and just order it quick and have it delivered. And so, it costs to build out that service level. And so that's why we want to continue to invest in making sure that our service level is the best.
Brilliant. Quick question on the Mailpac though. So how is the other side of it performing? Have you seen any slowdown? The deliveries with the Mailpac and the Price Smart and High-Low with the Mailpac local?
Definitely. It's funny we use the term slowdown, right? So slowdown, if you're talking about e-commerce and you're measuring slowdown, you should measure against 2019. Because what happened in 2020 is that you had this limitation in movement. And so you had this huge ramp up that was atypical. Somebody who likes to go to the supermarket because of the experience, get out of the house or whatever, literally and physically could not go. So they were forced to use these services. And so, of course, we saw this huge bump in our business. When we compare ourselves against 2019, which is our organic year, we are seeing growth in all of our businesses. But it's hard to measure anything against COVID. Similarly with the gyms, right? If I compare the gyms today versus 2019, and I shouldn't even say today because today is still COVID affected. But maybe at the end of this year, I should be comparing against 2019. I can't look at the gyms today as a measure of what our business will be 10 years from now. Our Hertz business, which, I said the story about 2008 when we didn't get Hertz. So it took 8 years. So in 2016, we actually bought Hertz. And that's a story of perseverance because that business was meant to be a Norbrook business, and we're very happy. And Nicholas Lynch, who runs that business, has been doing a great job But he measures his business against 2019 again because he would have gone through a cycle of no travel and lockdowns and whatever. And so the benchmark really should be a pre-COVID year for those businesses.
Okay. Yeah, man, it's really interesting that even when you're comparing like 2019 to now, I know that a lot of the companies in your portfolio, really thrived in social areas and social and just generally mobility and things like that, right? So with Apollo, for example, that changed up a little bit. With Express, for example, and I know even when you acquired Happy Ice and before you did the merger with with Pure National, right?
International.
Yeah, I know that the lack of events keeping or the lack of social gatherings and things that would have really affected the business in a very material way. So how's coming out of that bit now? Like, have you seen like a lot of a rebound? Is it that you see greater lights at the end of the horizon? Like, what's it looking like?
Yeah, rebound is happening different in every business. So we have businesses that were square in the center of the pandemic effect, right? So gyms, and then I don't know if you know, we partnered with Dean Shepherd at Blueprint to build a business called SMV, which we acquired Starlight, or the majority of Starlight.
I didn't know that.
And so OJ Bewley, who owns Starlight and is now a minority partner with us, that is in the event space, with event production. And then, as you said, the ice companies would provide for bars and restaurants and hotels and events. So that's square there, obviously the gyms and so on. So we are seeing different rebounds. Hertz actually beat this year, 2021, beat 2019, and so has fully rebounded and is probably likely to do about 20 to 30% more than it did last year, based on the trends so far. So we're seeing
Nice.
the tourism sector, or at least the car rental element of the tourism sector, fully rebound. We're seeing where the ice company, is having a balance in its portfolio. Hotels haven't come back fully.
When I was looking at that accounting officer job that y'all got over there.
Oh, really?
Yeah, I was just when I sent it yesterday or the day before.
Yeah, I was at yesterday or Thursday, one of them.
It was very recent. I was looking at it. I was saying, should I send that in?
Please do.
Will do.
It's a very exciting business. To see where that business is today with no events, it is scary to think what that business will look like when the world comes back.
Things really open, my God.
Yeah. And people use this word in COVID called pivot, but that business truly had to pivot, and they built an entire digital element of the business that probably wouldn't exist if the world was normal. But we were like, okay, how do we leverage our infrastructure to still allow people to have events? And there was this digital element of events that was built. And now, when the world comes back, you will have the old business and you have the new business.
Business as well.
And we see that a lot. Express built this outdoor gym platform called Hit Factory, where nobody could go inside. And now today, I actually saw a video where the inside of the gym is full and the outside of the gym is full at Hit Factory. And so I believe that a lot of our businesses will come out of the pandemic a lot better, a lot stronger, a lot bigger than they were in 2019, because you were forced to build new business lines and new technologies and new engagement tools, plus the old business that was going to make these businesses fly.
Exactly, man. Because we always had the ability to do these things, but like COVID kind of just forced the hand to actually action things like that,
Mm-hmm. The other thing that COVID did, we're looking at buying this business now outside of Jamaica, and they had a business that was really good, but their efficiency ratios were what they thought it could be, right? So the amount of people per store and serving customers per store is what it was. COVID came, and they're like, look, we can't afford to keep all these people, so let's find a way to become more efficient. And this is a survival instinct, right? You have to find a way to become more efficient. When the world starts to come back, they realize that the amount of people they could serve with the amount of people that they now had was a lot more than pre-COVID. So here comes this business that comes out of COVID a lot more efficient, and margins that are a lot higher than pre-COVID, just because, as you said, COVID forced their hand.
It's crazy, man. That's amazing. That's amazing.
Yeah. But you had asked a question, and my dog started barking, and he must have barked out the question out of my head. Did I answer your question?
Yeah. I think for the most part, as it relates to rebounds, anyway, man.
Yeah.
But I know. To me, all right. So let me just get over with it. So when I saw the acquisition for Happy Ice and then the merger to form Pure National Limited, I was like, yo, wait, hold on. They're really consolidating the whole ice business. They're really looking forward to really getting that social aspect of things in here, right? And then I also saw the recent joint venture with Jamaica producers, Jeffrey Hall as well, out in Dominican Republic, and they acquired another water company. It's like, okay, what's the focus here on ice and water? What's going on?
Yeah, I never thought about it that way because, as I said before, we don't actually have a focus other than buying well-positioned businesses. But we do have a focus on leveraging skill sets. And so when we were, the DR decision was less about ice and water and more about a new market. The Dominican Republic is the biggest market in the Caribbean. Very robust, 12 million people, double large GDP per capita. And Jamaica was becoming a much tougher environment in which to find good assets to buy, because everybody, whether it is a pan-chicken man or large company, thinks that their company is public and thinks that their company has a public valuation. And so, having people appreciate liquidity risk, when you buy a business in a private transaction, you're buying the whole business, you're taking on all the risk. Versus when you buy, a stock in a public company, you're spreading your money over a number of assets, and so you're spreading your risk. So you can pay higher because you have less risk. But when you are buying a company, fully, you have to pay lower because you're taking more risk. More importantly, you're taking on operational risk, because when you buy Mailpac shares, you know that I work for you. So I now need to go and the Mailpac team, it goes and does what it needs to do every day, wake up and figure out how to make Mailpac better. If you bought all of Mailpac, you have to wake up and figure that out. And that takes the risk and puts the risk on you. And so obviously there's a discount to that. So we found it more challenging to find reasonably priced businesses. And so we decided to look elsewhere. And when we go into new environments, same thing that we did when we went to the US, we tend to do things that we know already to get our foot in that market, because there is country risk, right? There's country and cultural risk. And then you go into a country that speaks a different language, the risk goes even greater. So buying the ice and water business over there, it's a great business. We love it. And and we think it's made it exceptionally well. And we have great partners there. But it was a lot easier because we already knew the ice and water business. Now, that said, there is a fundamental need for water, and that will never change, right? Because biologically, there's no technology that can replace the need for air or oxygen and water in our bodies. Similarly to health and wellness, there's nothing that you can do technologically. You can't inject anything or go on a game or whatever to make you healthier, to make your heart and your cardiovascular and whatever work better. And even logistics, there's nothing that can move technology-wise, logistics-wise, whatever, that can eliminate the need for an asset to move from point A, where it is made, to point B, to the end user. So there's some fundamental things that we believe in that will always be around. And obviously water is one of them. So being a part or a player in that space, we think will be a long-term growth play, because water is not going anywhere.
I mean, yeah, that's so true. And I was just thinking about it along the lines of, okay, you have businesses that are involved in logistics, distribution, and then you have, one of the largest, you have one of the largest ice companies out here in Jamaica, as well as building out the brand over in Domrep. I was wondering if there's any I know you say you don't really like to cross-pollinate the businesses, but it's clear it's right beside each other. So I was wondering if there was any plans to go through with that.
Yeah. Today there is no direct synergies, but as I said, there's a lot of cross-pollination and learnings. So the management teams, each one has their own best practices. And what we've done by sitting in the middle is saying, hey, this is some things that really work well for us in Pure National. Let's try to implement those at Alaska. And here's some things that really work well at Alaska. Let's try to implement those at Pure National. But the business is becoming one is not in the near future.
Okay.
So, all right. Question now on the outlook. You mentioned a while ago that in the private market here, you find it a bit more difficult to execute transactions in Jamaica due to people and the valuation that they want in the private market. So, given that, what is your outlook for both private transaction spaces, and do you think these people should come to the public market? And if so, why are they not doing so at a more rapid rate? Outside of COVID, of course. I mean, we know we've seen a large uptick, but still.
Yeah. So it's funny it's hard to talk about outside of COVID when you're in COVID, still in the tail end of COVID, right?
Yeah.
So I think COVID has definitely impacted a momentum that we had in Jamaica that was never seen before, right? We had a couple IPOs lined up for 2020. We had momentum in many of our businesses that were, unseen before. The economy was driving. The vibe and the culture in Jamaica was, really positive for the first time in a long time. And then comes COVID, right?
Yeah.
And so COVID put a lot of people's growth strategies and growth prospects on the shelf. And in fact, most people just went into hunker down mode, like, how do I protect my business from not going under? And so what the world looks like coming out of COVID is going to be interesting, because it's going to depend on how much of a hit the economy took, right? And that doesn't become apparent until about a year or two afterwards. The people who had investment capacity in 2019, if they lost 20% of it, now they only have 80% of that capital to invest. If they lost 80% of it, now they only have 20% left. And we don't know. We don't know what that looks like, because a lot of these are families that have family-run businesses that are spending money to support their businesses. And obviously that's private information. But what I will say that valuations are cyclical. Interest rates are cyclical. Economies are cyclical. So there will be a time when Jamaica goes up and valuations are up and everybody's, riding high. And then there's a time when things will come down. And, if you look at somebody like Warren Buffett, who's had 70 years of investing, his methodology has always been, I've been telling people about this book, The Intelligent Investor, which, still has pertinence today. But if you truly are a value investor and you understand the intrinsic value of an asset, then you should only be buying those assets when they're priced fairly or below their fair intrinsic value. So if the market is bubbly and assets are high, we wouldn't be buyers in that market. And when things settle and things come back to a fair price, then we would be buyers then. But on the flip side, if you're a seller, you sell when the market is bubbly, right?
Absolutely.
And so, I'm seeing that here in Florida, where a ton of my neighbors are selling their homes, not because they wanted to, but because the homes are valued 2 times what they were last year. And so they said, I was thinking about moving anyway. Let me just go sell the house and, go move somewhere else. So the outlook for me is, one of a wait and see unless we see unique opportunities. But what COVID has also done is brought unique opportunities. People who have built value over a long time, have run good businesses, But now they hit upon this hurdle called COVID, and I said, you know what happened? I don't feel like starting, because that's what it feels like, right? So, the business was put on hold. If I was at a different age and stage, and what happened to the gyms happened, and we just get put on hold. At some point, he said, I really want to start back the cycle. And so we're seeing people just say, you know what, I'll sell my business. I'll exit, give opportunity for somebody else to take it forward, and I'll go into retirement. I was going to go anyway, but this COVID thing has created an opportunity. So we are seeing that, and we're being opportunistic about that. But generally, I'm hopeful that when COVID dissipates, that the market picks up where it left off, because we were really at a good stage in Jamaica.
Agree.
Absolutely. Definitely there. And speaking of where we were right before COVID, there were talks about Express Fitness listing on the junior market. Is there anything you can speak towards on that?
Yeah, that was in the plans. We had a signed agreement with an investment bank in Jamaica for Express to go public. The business was at an amazing growth pace, but also had a ton of potential. We were looking at some acquisitions regionally. We were opening new gyms. We opened up a new concept. In fact, our concept in Mugbe called 365 Fitness is a lower tier gym for the broader socioeconomic market. And the day we opened that gym in February 2020, it had more members. It had 2 times more members than the largest Express gym. So we had a theory around the downstream capabilities of creating health and wellness for Jamaica, for the broader Jamaica market. And people say you're crazy. Nobody wants to spend that money in that market to go to a gym. That was proved wrong, but and 365 is still there, and we're seeing now we're at about 60% of where we were pre-COVID. But will Express go public again in the future? Who knows? Who knows what the future holds?
Who knows? Yeah.
All right.
Well, yeah, we definitely want to see. Yeah, we definitely want to see. When we can confirm or say, okay, yeah, man, we're out of the woods with COVID and everything, and by then you probably want a little bit more time just to let get at least closer to full capacity or full operations. That way, it looks better on the numbers, right? Because the numbers are going to determine the price that the listed at. It's going to determine the size of the deal and how much you're raising and just the general valuation, right?
Yep.
So yeah, because that's what I imagine for the ICE business as well. For Pure National anyway.
Yeah. All of our businesses are independent, right? They're autonomous. They run like a fully self-governed business. So any of our businesses could list if the exit made sense. But if you remember your question about exits, we will exit if there's a strategic value to exiting. I think our businesses are built for long term, and so because they're built for long term, they're attractive to investors, because institutional investors are who make up the majority of the public markets. And if they can invest in a company that they believe will generate good cash on cash returns over the long haul, and not speculative returns, then that's for them. And that's who we would want to have as institutional partners anyway. Speculation is not our game. I don't own one Bitcoin or Ether. It's because it goes back to intrinsic value. I can't tell you what intrinsic value of a Bitcoin is today. But I can tell you what intrinsic value of selling 5-gallon water in Dominican Republic is, because I understand how much can sell, what our cost to produce it is, what our cost to deliver it is, and I can value that potential cash flow.
Yeah, man, for sure. Because I mean, there are a billion ways to make $1 billion, man. You know, there's just whichever way you want to choose. You know.
Yep. That's one of the things you'll see in that Intelligent Investor book, is that there's a space for speculation, but people need to appreciate what the difference is between speculation and investing. And sometimes people get them confused. And if you feel like investing is speculation, then you can take excessive risk that you shouldn't be taking. So, if you have a part of your portfolio that you say, listen, I'm going to speculate with this part of my portfolio. I'm going to try and understand these businesses or these stocks or whatever, I'm going to invest in them. As you said, there's good returns that can be garnered there. But you also need to be smart about your portfolio management. So you shouldn't be taking all of your money and speculating, because then you're taking risk on all of your money. But that's a view that Graham had in 65, and many value investors still believe in. But there is value in speculation for sure, and many people have made good returns.
Yeah, man, for sure. Yeah, man, me if you tell you.
I am sure.
Yeah, man. Trust me, man. It's real great stuff. But yeah.
The one other thing I'm saying that is, you also have to know that you have, and there's another book called The Psychology of Money that talks about the psychological elements of speculating. And if you don't have the emotional capacity to manage through the ups and downs of speculative investing, then you can make some mistakes as well. So I know myself, and if I play football and I forget even losing, a goal score against me, it's psychologically I lose my bearings. And so because of that, I know that if I was to speculate and the stock or the asset moved against me, I may make bad decisions because I can't manage it. And so that's why, there's just certain things that I just don't take the chance with. But I shouldn't say take the chance with. I don't do, because you need to have emotional stability to manage that. Right. I used to work alongside traders at Goldman, for example, where those guys were taking risk at the side, on significant positions. Mm-hmm. And they would just go to dinner, they would make the trade and know that it's out there and it could be going up or down. And I was sitting at dinner, having a drink or whatever, and I'd be on my phone like every second. So to each his own. You have to know yourself and know your portfolio and know how you manage your risk within your portfolio. Yeah. To make sure you're maximizing your long-term benefit.
Yeah, man, for sure. Because it's all about knowing, number one, your risk profile, mm-hmm. right? Because if you don't have the psychology for certain types of assets, then or certain types of investments, then you're just not going to have a good time. It may work out for you, but that whole stretch of between acquisition to doing what you're doing, then you might just not feel the best for you. So you need to know exactly what you're looking for. Yeah. Right? Because for me, I'm not super big on diversification personally with my own portfolio. Maybe because I'm mainly in stocks, and so I understand that you can't spread out your entire portfolio too thin, because whatever returns you get on a particular investment, it's not going to impact. So for example, even if you get one and it goes up 100%, all of the others would need to go up 100% for your entire portfolio to go up by value. So I'm a little bit more on the concentration side of things, but I will invest.
What do you concentrate on? What's your core assets that you invest in?
Right now, what's my portfolio looking like? I have a lot of. I'm looking. All right, so I do it by place. So right now, I have a lot of general insurance. I have a lot of my portfolio is in general insurance, right? So
the sector. So stocks is what you.
Yeah, stocks. Yeah.
I got you. So no bonds, no.
No, bonds feel boring,
I keep telling this guy there's so much that can happen. I'm a portfolio allocation guy myself. I always love looking at different asset classes and those kind of things. So I even regular we have conversations about doing stuff like what you do, just buying businesses outright. It's like you look at something and you'd be like, I'd love to just own that entire thing over there, the whole of it. That no 2%, I just want to have like the whole thing. So,
Exactly.
So it's
That's a good balance between you guys. You guys invest together at all, or just talk and share ideas?
Right now,
sometimes it's a blend. Sometimes it's a blend, right?
It's
so like
true.
So we have like a group chat of us. So this all started in UE for us, right? So Sean and I actually went on work and travel one summer in 2018. Yeah, and that just did not work out very well for us. But guess what? We had a little. It did not work out, but we had a little more money in our pockets. So while we were there, we said to ourselves, that, okay, we cannot allow a repeat of the situation to happen. We need to advance ourselves, mentally, our understanding of finances, and our, just our net worth in general, right? So we got very focused in the stock market and say, okay, this historically is the greatest vehicle for wealth creation. So stocks are starting out with, and we just found more and more like-minded individuals who could bounce ideas off of, who could teach us, who could just get us to understand a lot. One of the big players for us was Randy Rowe from Every Mickle, and so he was a
Twitter guy.
Randy used to work with Kimala.
Yes, at Lab.
Yeah, boy, I'll tell you, it is, and this is the evolution of people. Yeah, when I was coming out of college, I wouldn't say that any of my, and this was in the US and in Jamaica though, any of my colleagues were talking about investing, or my peers were talking about investing and future planning and whatever. Even though people would come to us all the time and say, make sure you plan, start planning for your future today, plan whatever. And we're like, whatever, just want to go have some fun. And I find that the generations after us more and more started to care more about their longevity, their investment and portfolio, and they got greater access, so it was easier to trade and get involved and get information. And I keep going back to this book, but Psychology of Money talks about the tenure. The biggest factor in wealth creation is the tenure of your investing. So they said if Ray Dalio was to invest for as long as Warren Buffett did, then he would be something like 110 times wealthier than Warren Buffett, because he has a higher rate of return than Warren Buffett. But he started in his 40s. Warren Buffett started at 13. So, when my generation starts, thinking about this stuff at 35 and 40, we've missed 20 years of wealth creation. And so to see, you guys and the generation I see on Twitter and so on, there's a generation out there that's like excited to start building wealth at that stage and age. You are 50% ahead of the game. By the time you get to where my generation would have started investing, you're way past us.
Yeah, man. It's the benefit of compounding, really and truly. So, like, the earlier you start, naturally, the better off you're going to be. You're going to be more seasoned in understanding the markets and understanding how the mechanics of it all. Yeah, man, for sure. And naturally, there's that as well. But then, to be very frank, like, we've lived through like 3 major world events already, right? You had the dot-com bubble in the 2000s, right? When we just rebound, basically. Yeah, the financial crisis 2008, 2009. You have COVID. So at some point, you're going to be like, Jano.
Don't forget 9/11 happened, bro. So even though that didn't affect Jamaica directly, the impact on like air travel and all of the past.
Tourism was significantly impacted by that.
Yep.
That's very cool. I'm happy to see what's happening with you guys and the generation. So at least I know somebody one day will come and buy Norbrook from me at a good price.
I will tell him.
Just kidding. Talk to after.
Well, man, it's amazing, man. Yeah, it's been amazing talking with you, Khary. Man, yeah, I'm sure all of you are going to love this one for sure. But yeah, man,
I appreciate it, and I appreciate the time. And I as I said, I learn not just from what I am doing and what the team at Norbrook is doing and whatever, but also from what the people coming up behind us are doing. And so let's keep in touch and keep doing what you're doing and keep educating the people out there that should be educated to be better, to build better, to invest better.
Man, absolutely, man. All right, man, that sounds great. All right, everybody, this has been Justin Scott and Sean Anthony Thomas with Khary Robinson. This is The Vault. Remember to tune in. We'll be dropping these on the Sundays. Go and watch all our previous videos. Like, comment, share, and subscribe. And we'll be in touch soon.